I've talked a bit over time, over many years actually, about capital taxation, and most recently in relation to the Office of Tax Simplification review of inheritance tax and capital gains tax, but I'm talking about inheritance tax in this video. So we're waiting for the government to possibly do something, or maybe nothing, as a reaction to the OTS reports, two of them, on inheritance tax. And there's a sort of calm before maybe the storm that might come in the budget, no particular insight into that, might come in the next budget. We're waiting to see what the next budget holds, because the last budget held pretty much nothing in relation to inheritance tax, a little bit on tax day in relation to IHT administration and simplifying the completion of forms and reducing the need to complete inheritance tax forms for many, many estates, long overdue. So that's good, but nothing fundamentally around IHT reform. Just recently, the OECD have reviewed estate taxes, inheritance taxes in 26 out of the 37 OECD countries. And the report they published was quite interesting. And there's some similarities in what they think would be a good IHT system and those which the Office of Tax Simplification have put forward to some extent, and in relation to IHT and a bit of the CGT report. So just having a look at this, I'm going to stare down at my iPad here with this stuff on it. Basically, they had a look at these and said, something we all know already is that IHT, actually, the inheritance taxes, whatever you call them in those other countries and in the UK, yield such a small proportion of the overall tax yield. It's on average in the OECD, it's just 0.5% of all tax revenues on average is generated by inheritance tax. In the UK, slightly above the average at 0.07%, so just a little bit above 0.5%. They believe, though, that inheritance tax have the capability, with the reform, inheritance taxes have the capability to help reduce inequalities and help to spread assets more. I'm a little sceptical, to be honest, about that in terms of the ability to spread assets more, but that's just me talking. The suggestions that they put forward are quite interesting, and some of those may resonate with you because you think, maybe I've heard these before. They're quite a lot like the Intergenerational Commission's 2018 report. So let's have a look at the recommendations they make and see if you think they make sense. Not that it really matters unless the OECD, you have the ear of the OECD, and whether you think they're likely to go forward. It's as well to know these because some of your clients might ask them, your professional connections might ask about them. So, or you could just raise them in the, just to be proactive around showing what you know about what's going on. So recommendation number 1, tax the recipients, not the donor, basically a donee basis of tax. And that is it helps spread wealth more widely. And that's where I get a bit skeptical. If you're the owner of wealth in your family, where do you want your money to go, your assets to go? To your family. Okay, that's it. And if they go, oh, you could spread it wide, you could reduce the tax by giving it to more people. You go, yeah, but I don't want to give my money to those more people. So I'm not sure about that working out, but that's something they put forward. A donee-based tax is something that is much more prevalent across Europe rather than in the UK and the US, where it's a donor-based tax, as we know. Taxing through lifetime, rather than having this ability to recycle the nil rate band that we have in the UK, saying, look, there's going to be, and having annual exemptions, saying there's going to be a one-off cumulative lifetime allowance for giving stuff away, not this recyclable, reusable amount every 7 years, for example. So that's something they put forward because they believe the system as it stands, where people have reusable allowances every 7 years, for example, favours wealthy families. Many of your clients will be wealthy, and so I'm sure they're not upset with that. Use progressive tax rates rather than a flat rate. Generally, most people say that's a good thing in relation to taxation. Scale back on tax exemptions is one they put forward, and they single out, listen to this, they single out pensions and life insurance policies as being something that produces regressive results. They also suggest having a big review of the exemptions for business assets. The OECD's view is that business reliefs predominantly benefit the very wealthy and have sometimes been unnecessarily generous, and they distort investment to some extent. So that's something they suggest reviewing, saying the reliefs around the OECD, and the UK will be included in that, are too generous. Trust rules and those for similar structures should be revised to prevent avoidance. Basically, they say trusts are okay. And remember, quite recently, on tax day, the 2018 review of trust taxation was mentioned and said that basically we're not going to make any reforms to trust taxation in the UK. But in the OECD, also, trusts are generally okay, but say that government should be constantly on their toes, being aware of the use of trust for tax avoidance. And I think the UK have largely done a very good job with the anti-avoidance rules, if the job was to prevent avoidance, basically. And last, this is one that is familiar, the automatic uplift for capital gains on death should be scrapped. And we know that the OTS, the Office of Tax Simplification, have suggested that in their proposals for reform of inheritance tax, saying that there should be no CGT uplift if the assets being left on death also qualify for OHT relief or exemption. And the OTS in their CGT reform went a little further and said in the CGT paper, actually, there should be no uplift, full stop, regardless of whether the assets are free of inheritance tax or not. So that's where we are with the OECD. We know where we are with the Office of Tax Simplification. And if you're thinking, when are they going to get round to looking at those provisions on inheritance tax? And the one thing we had, according to a statement on tax day, and you can see this in our bulletin on TechLink, the Treasury's response to the second OTS report, they said, will emerge in due course. Watch this space.